Welcome. Welcome, everyone. It's Angelo Robles. The end of easy money. We're also going to talk AI, authoritarians, and the fall of dollar hegemony. We'll see. We have a very special guest today, and we're very fortunate to have Scott Slayton, CFA and partner in chief strategist at Capital Creek Partners, joining us all the way from Texas, and former head of asset allocation at UTIMCO, one of the world's largest endowments. So, what happens when the world no longer trusts the dollar? When authoritarians out-strategize democracies, if that's a word I'm thinking of, and when AI plus crypto sometimes become the only future forward game in town. So Scott Slayton is not just guessing, he's been at the machinery of global capital allocation from the inside. As I mentioned, former head of asset allocation at UTIMCO, one of the world's largest public endowments in the US, and a veteran at Tudor, meaning Tudor Jones back in the good old Greenwich days. So I can relate to that. Morgan Stanley and Jamison Capital. We're going to talk about US debt and dollar risk, Bitcoin, gold, the next monetary quote unquote regime, China, rare earths, a little bit of geopolitics, macroeconomics. My God, Scott, we have a lot to cover. Scott, welcome.
Thank you, Angelo. It's a pleasure to be with you and your audience this morning.
Well, you're very kind. It's great to have you on. I've not done as much of a deeper dive into more macroeconomics and investing, longer form with a guest in probably about 2 or 3 months. And really, it's probably where I'm most at home, other than maybe AI, but this will correlate into parts of that as well. So let's get right to it. Are we past the point of no return on US debt? 37 trillion and growing, and the big beautiful bill is going to be adding to it. What does fiscal sobriety even look like now?
Well, my short answer to that is no. I don't think we're past the point of no return, but I do think we're edging toward it. And those who have been around a long time might remember an eccentric but very, very successful and patriotic Texan named Ross Perot. Back in 1992, when he was running for president, he was alarming the entire country about the US fiscal crisis that was coming. Well, that was over 30 years ago, and we have not had a fiscal crisis since then. Some measures were taken in the early 1990s, and we actually had a surplus in 1996. Now, we're a long way from that today with 36 trillion in debt and mounting, and we're adding to it about 2 trillion a year. Interestingly, this afternoon, we're going to auction $22 billion of 30-year US Treasury paper. Mm-hmm. And it'll be interesting to see how the market handles that. I think the market's going to handle it just fine. In my long 35-year career, I've noticed that when people are fixated on a crisis, that a crisis happens elsewhere. That just tends to be the way markets work. If everybody's focused on something, it tends not to be a problem. But in the intermediate and longer term, I think the US is playing with fire in adding to its deficit at this rate, especially with interest rates now back at what I would describe as normal levels. This debt has become much more expensive. And we're going to keep adding to it. And the interest costs are probably going to come down, in my opinion, over the next year or so, which will help. But I think it's going to take a crisis, Angelo, to focus the minds of politicians in the country to deal with this problem. And I think it is the greatest problem that the country faces today. And let me explain a little bit about how I think politics works in the United States. Politicians in the US have become professionals, and they generally want to make a career of politics. It's fun. You get paid a lot indirectly, I suppose, if not directly, for being a US politician, and you have power. And most people in the world lust for power. And so these politicians enjoy their job. They want to keep their job. And the way they keep their job is by delivering goods and services back to their constituents. If they take goods and services i.e. money, away from their constituents, they will be voted out of office. That has happened in democracies all over the world. Greece is a great example. When they went through their crisis, 2009 to 2018, the people who committed them to austerity were summarily dismissed from their jobs. And I believe that is what American politicians expect if they pursue austerity. So they are not incentivized to pursue austerity. Therefore, they will not pursue it unless they are forced to pursue it. And I believe that ultimately they will be forced to pursue some form of austerity, which will probably take the mix of some revenue increases and cost cuts, because we're pretty much a 50-50 country. And I think to get real compromise, which will be necessary, we'll need to probably raise taxes and cut spending. Maybe not in equal parts. I think we have more of a spending problem than a revenue problem. But in order to get it done, I think it'll take both. And it will take a crisis to crystallize and catalyze the politicians and even the administration, whichever administration is in power at that time, to do what they must do to put the country back on a sustainable fiscal trajectory.
Well, Scott, there's so much there to overused word unpack. I mostly agree with it. The debt to GDP ratio, horrific, 37 trillion and growing, the big, beautiful bill adding to it. There appears to be no end in sight. Money printing, money printing, money printing. You look back to Bretton Woods, you look back to 1971, coming off the gold standard, and basically it's somewhat a game. It's a fiat Ponzi scheme, if I could use that word, and just keep on printing until that merry-go-round just doesn't go around anymore. And Ray Dalio has spoken about this, and other Grenadite, as of course you would know. And the global debt's a big challenge. Completely agree with you on politicians. Their number one goal is to get elected, and 2, 3, 4, 5, 6, 7, 8, 9, 10 to get reelected. In case you can't because of term limits anymore, and then it's probably to get rich, capitalize, and enhance your power even further. Therefore, playing to their constituency, of course, all they care about is who's voting, what's the demographic, and how could I appease them. Therefore, cutting certain entitlements is probably not going to happen, although I could argue sadly should, because of fiscal irresponsibility by our government is the only thing that props up this charade, Scott. The fact that we are the world reserve currency, that the world settles, although it's subtly decreasing in dollars, what about 70%? And we can look at oil and all that. When does that stop?
I don't think the only thing propping it up is the reserve currency, but I think it's a major prop in continuing the regime. And I think the dollar's reign as the reserve currency will continue for the foreseeable future, although it will be weakening over time. De-dollarization is a major theme. There are formidable countries, even in what I might call an axis of authoritarianism, which I've dubbed the sinkers: China, Iran, North Korea, and Russia, all working in concert. And probably many other countries would prefer to escape from this dollar hegemony. But I do think it's a major thing that is propping it up. Other things that are propping it up are the need for liquidity. The US Treasury bond market is the world's most liquid market, and I would maintain the world's most important market in many respects. Large trading partners need a place to park their dollars. And remember that even 10-year paper is yielding close to 4.5%, which is not so bad. So I think nominally higher interest rates than we've seen in the last 15 years are part of it. The liquidity is part of it. I think there is still a fairly strong belief in the full faith and credit of the United States to meet its debts, although our politicians try over and over to erode that full faith and credit. But I think it's largely still there, and the desire to own American assets part of which is the reciprocal of the trade deficit is the capital account surplus. That is a strong bid for dollars and for U.S. Treasury paper. So while I think that a crisis is inevitable that will force politicians to get straight with this, I believe it's not imminent. And I would put it somewhere in the 2 to 5 to 7 year time frame, depending upon what measures are taken over the next 12 to 18 months, what this administration decides to do. Now, the one big beautiful bill, as you mentioned, is an additive to the deficit. And I think is very disappointing to some of us who hoped that the administration would have a more serious take on our fiscal profligacy. But that does not appear to be the case. And yeah, and I don't think, maybe it was foolishness to even expect it in the first place. But I think, Angela, one thing that there's I think a mistake within the administration, which is a fixation on trade. We have two large deficits, the budget deficit and the trade deficit. There's been a lot of seriousness and action on the trade deficit, but there's been almost no action on the budget deficit. And I would maintain that the administration could really help the trade deficit if they reduce the budget deficit. Think about this. If our revenues are about 5 trillion and our spending is 7 trillion, we're running a $2 trillion deficit. If we cut it by $1 trillion, there would be a lot less money in the pockets of American consumers to buy foreign goods, and the trade deficit would naturally narrow. But I don't think that logic really has been embraced by the administration. They're fixated on trade, and I think they're fixated on it because they feel like they can be unilateral and they can do it without any help from anybody else. They can just do it of their own volition, whereas the budget deficit is going to take a lot of negotiation, a lot of pain on both sides. They will need the Democrats probably to participate in some form or fashion to get it done and to be acceptable by the country at large, because there's going to be a lot of sacrifice needed to deal with it. And so it's just much tougher to deal with the budget deficit than the trade deficit.
And looking a little bit at treasuries, and again, the markets and buying treasuries, obviously Japan and China in the past have been the two largest, at least from outsiders, meaning foreign. But there is, as Trump's regime is very quote unquote crypto friendly, has David Sachs on board. Stable coins are going to be very important in a new world moving forward. The most massive of those is still a private company called Tether, but the second largest one is one that is now a public company, Circle. Yes. So I look at companies like Circle, like Tether, and like others, and again, stable coins effectively backed, I believe, and I hope, by U.S. treasuries. That could be a boom that theoretically keeps things, let's go with the word propped up, maybe for years to come, keeps the dollar, again, the world reserve currency, because there really is also no true competitor. Now, that's a positive light. On the negative light, I could add, like I stated earlier, let's just keep the fiat Ponzi scheme going longer and longer until one day, 7, 10, 15, 20 years, it just blows up. So are these necessarily positives? Are they negatives? And again, I go back to politicians and their constituency. Keep things going, get reelected, and all is good. Although it's not really good for our kids and grandkids.
Boy, I agree with virtually everything you said there. And I should have also mentioned stable coins as a potential additional prop to the dollar's reserve currency status. And I think that you're absolutely right, that within the administration, we have people that understand this. I think David Sachs understands it very well. I think Scott Bessent understands it very well. They probably communicated this to the president. And it's very important. I think stable coins are one of the biggest most important trends that people don't understand and don't really know about. These frictionless currencies that can be settled very quickly and all over the world. And I'm thinking, if I'm in Argentina, well, maybe we should pick a different country because Argentina is on the ups, but another country in a region of the world where there's instability might really want to hold these stable coins in US dollars, because the dollar, with all of its flaws, is still much better than many other fiat currencies. When I think of currencies, Angelo, I think of what Ray Dalio described as an ugly contest. They're all ugly. The question is, which one is least ugly and which ones are the most ugly? They're all bad. All countries are working either very hard or slowly to devalue their currencies. That's just the history of fiat currencies over 1,000 years, whether they were coins that used to be clipped by Roman emperors, or they are the reserve currency that Richard Nixon devalued in 1971. It has happened all throughout monetary history. Ken Rogoff has written a great book, Our Dollar, Your Problem, that goes into a lot of this. I'd encourage our listeners to read that book. It's the latest book on this subject from a very good source, I believe. And so the history of currencies is devaluation over time. But I like these stable coins. I've used them myself just to understand them better. And I think they're going to be a very big deal globally. And I hope and kind of expect that they will be denominated, at least in the beginning, in US dollars. And that's bullish for the dollar. That's one of the reasons that I could be wrong on my secular bearish thesis for the dollar.
True. No, it's great to admit that again, nothing's perfect. Of course, we all could be wrong. Most folks won't admit that, though. Changing directions a little bit, and my audience knows I do tend, especially on great guests like you, to bounce around a lot. A little bit on some investing fronts. 74% of global market cap is effectively U.S. companies. I guess people could say that won't last, but then there must be an alternative. Where is the money going? To non-U.S., to emerging markets, to where? And the U.S. is still king. I mean, how many companies in the Fortune 500 that have come from Europe in the last 50 years? I believe the answer is a zero. And the U.S. has Silicon Valley. The U.S. is among a leader in AI. So although it sounds like maybe its time is up, we should be looking at other perspectives, I'm not sure. One more stat I'll leave you with, then I'll let you answer that question. I believe the S&P is up totally 297% since 2008. The rest of the world, -4%. Now, is that going to last forever? I guess not. And now we're talking market timing. I get it. But how do you look at this as being a former allocator at a gigantic endowment? And now in terms of what you're doing now, again, does this train keep on going forever?
I think about it a great deal, Angelo, in my former roles and my role today, because now I'm helping to allocate capital for very wealthy families, which are our clients. And one of the key points that I wanted to communicate to the audience today is the importance of global diversification in an increasingly multipolar world. So the concept of US exceptionalism was probably at its absolute peak right around the time of the current president's election back in November of 2024. And the consensus belief was that we would have faster growth, we would have we would have animal spirits, we would have very strong earnings growth for the S&P 500. And what has happened is, in some ways, the exact opposite. We have a fixation on trade. We have one of the largest tax increases we've seen in a generation. We have disruption, in some cases, intentional disruption of the current world order, where the US really is by economically and in some ways technologically the leader. I don't know why we would want to disturb our number one pole position, but for some reason it seems that we do. And so this concept of US exceptionalism, I think, is under pressure. And it probably was overblown to begin with. But the soft power and the brand of the US has come under some pressure in the last 150 days, in my opinion. And that argues for serious investors who are somewhat risk averse, and I think most of us are, or at least risk prudent. We need to have global diversification because the US enjoyed unipolar status from the time the Berlin Wall fell until, arguably, just before the global pandemic. It's a multipolar world now. As I mentioned, the sinkers as an axis of authoritarianism to take on the Western democracies. And I think they're going to be very formidable, because when you think of the military power, the increasing technological innovation, especially concentrated in China, we must admit there has been some great effectiveness of in a very rapidly changing world of an authoritarian regime saying, look, go dominate electric vehicles, go dominate batteries, go dominate solar panels, things of that nature, and actually seeing it come to fruition. That's pretty scary to me. I'm concerned about that. And so I do believe American exceptionalism has peaked for the time being. I think that the US dominance in the global indices like the MSCI All Country World Index has peaked. And I think we do need to own equities and fixed income products and currencies in other countries, especially with the backdrop of what I see as a secular decline in the US dollar and a slow unwinding of the reserve currency status probably over quite a long time. And we can get into that later. But I think for our families, we are highly focused on global diversification for all those reasons. And I think it was actually the number one point that I wanted to make.
Well, excellent. And I'm pretty much on board with that. I may go a little back and forth with you and have some disagreements on it. But as I have worked in the family office world for decades, know significant multi-billion dollar families, I would say the vast majority, close to 100%, probably have 95 to 99% effectively dollar denominated assets. If you look at the global studies from UBS, very, very, very few families own anything moderately substantial, like above even 1.5% in gold, relatively just incredibly nominal in Bitcoin, and really not too much true less dollar denominated assets, real estate, private businesses, etc. internationally. Yeah, you're probably okay short term, but that creates an issue given on some of the macroeconomic and geopolitical challenges that we mentioned earlier, longer term. I get it. I'm probably complicating your life by having a level of more diversity from a variety of different perspectives. But at the end of the day, that is going to be important. Let me go back and forth with you a little bit on wealth preservation. So there is a perception among the super rich that we already hit it out of the park. We're now in wealth preservation mode. And I guess we think of Warren Buffett, rule number one, don't lose money. Rule number two, remember rule number one. And I understand there's a logic to all of that. And maybe I'm just trying to be a little bit combative. But could I make a counter argument to that? The counter argument is, what are you teaching your rising generations? That you got lucky the first time, that we have to hold on to what we got, that we don't take calculated risk anymore, that we don't look at the realities of how the world works and foster and encourage entrepreneurship and growth, coupled with the impact of inflation, the true inflation for the super rich, distributions, taxation, at minimal over time, having a hyper conservative approach, you're going to lose purchasing power. Therefore, and maybe I'm a bit of a gunslinger, maybe I'm somewhat an advocate of have an intimate number of holdings in your basket, Munger said, but watch that basket very, very, very closely. Why don't I get your broad opinion on that? And then we can riff a little bit from depending on your responses.
Well, there was a lot there, Angelo, and that's very rich territory. One point I want to make about further point about U.S. exceptionalism, and then I'll go into how wealthy families ought to be thinking and allocating. That the reciprocal of a trade deficit is a capital account surplus, and money goes where it's treated best. And it's been treated best in the United States my entire career. I think at the margin, we're not treating it quite as well as we used to. And we're assuming that it's just going to continue to come here, even if we don't treat it as well. And I worry about that. And that's part of the reason why I think we remember from Business School 101 that diversification is the only free lunch. I still believe in it. I understand Munger and his, have the one egg and watch that egg like a hawk. But when you look at the activities of Charlie Munger and Warren Buffett, they were actually great diversifiers. So that, I think that was more of a great line than what they actually pursued. And one of the other points I wanted to make in this interview was that I think exposure to what I would call public and private alternative assets are going to be very important for very wealthy people over the next 10 plus years. I agree with you wholeheartedly that if you've made your money, if you've made enough money, let's say $1 billion, you can keep it all in cash and just deal with the degradation of your purchasing power because you'll still have a lot of purchasing power. But if you've made 100 million, it's a little different. If you want to pass it down to your heirs, you need that money to keep up and return greater than the rate of inflation to maintain and even grow your purchasing power. And I think that's doable, but I'm not sure it's going to be doable in a traditional 60-40 portfolio of public treasury bonds and credit and equities. I think our wealthy individuals are going to need to own more of these different kinds of assets. Private equity, private credit. Private credit is I think one of the most interesting assets right now, and I hope we can discuss that a little later. Venture capital is important. Infrastructure is important. Energy is important for inflation sensitivity and defense against inflation, especially now when energy is very depressed. So there are other ways to make money. And then the public alternatives, which I would consider precious metals. Gold is very interesting. It's had a wonderful bull market. It's been an asset that I've been involved in successfully for over 25 years. But there's also silver and platinum, which are bull markets. Last week was an amazing week for both silver and platinum. Just to give some stats on silver. Silver is roughly $35 an ounce. It was almost 15 years ago. It hit $50 an ounce. It's way far away from an all-time high. And in real terms, it's light years away from a new high. So that's an interesting market.
And it has incredible industrial uses. And as we increase data centers and technologies, you would think copper, silver, some of the other metals and critical metals that you noted should skyrocket up. It's almost a little, well, I want to be a little careful here. Like it's almost like it was being artificially suppressed. Like why?
Well, I think Angelo, I think it's because central banks almost exclusively buy gold. There are some innovative and avant-garde central banks which will buy palladium and platinum and silver, and heaven forbid, even digital currencies. but largely they own almost exclusively gold. And I think the public are waking up and saying, wow, look at the gold silver ratio. You can buy almost 100 ounces of silver with 1 ounce of gold. That is about as low as it gets over the last 6 decades.
Wow.
So that's really interesting. And platinum was kind of left for dead because everybody was focused on electric vehicles. A lot of platinum went into catalytic converters. Those are going away. Well, we're finding, like so many other things, they're not going away. That electric vehicles will take share over time, but gasoline combustion engines will still be with us probably in 10 or 15 years. So the platinum market exploded last week. And I can remember for most of my career, platinum traded at a premium to gold. It trades at a third the price of gold today. So I think even diversifying out of gold into these other ancillary or alternative metals are interesting. I agree with you. Copper has some of the best fundamentals of any metal I've ever seen over the intermediate longer term. And aluminum is another metal that's acting well. So what else does this tell us, Angelo? It tells us we're not going to have a recession anytime soon, in my opinion. Even with tariffs, we are not going to have a recession. We're going to have a slowdown. But look at the rebound in the second quarter. I know we haven't felt the full brunt of the tariffs, but I think it's going to be less of a problem than we anticipated a couple of months ago. So the other thing I must mention would be the digital currencies. And I think that's somewhere you want to go here with the discussion. I think it's essential that very wealthy clients have at least a small allocation to this exciting new area, because while I don't fully understand it, I do see the convergence of digital currencies and AI and robotics and what Mark Zuckerberg called the metasphere, I think, or something like that. It's all coming together before our very eyes. And I think digital currencies are going to play a role in that. And it feels to me like zero is just absolutely the wrong allocation to that world.
Oh, trust me, Scott. We're getting to AI. We're getting to Bitcoin. It's coming. But I do want to stay a little bit for just a little while longer on kind of the core question that I did ask, and I'm going to build it out a little bit. And I think this is probably going to be the one area where we're going to disagree, and that's great. Like
good.
Like I desire this. Now, you do have the endowment background, which may placate a little bit into some of the mindset. So I'm going to go back again. I do think that families, from my perspective, they overly diversify. How many great ideas actually do you really have? And how many managers, and I know I'm effectively Greenwich, Connecticut, hedge fund managers are beating net of fees and taxation, even the indices, let alone the lack of liquidity. So a little deeper, I actually do think that Munger and Buffett back in the day, yes, their volume of holdings, but I think that's a little misleading. What I care about is what's your concentration with your top 3, your top 5, your top 7. And I believe broadly that made up about 55 to 60% of their portfolio. Because I dabble in the stock market, technically, I also have a lot of holdings, and I'm not necessarily recommending that. I am an advocate of a more concentrated portfolio. With me, well, I don't want to waste the audience's time on it, but I believe it's hard to beat certain indices. Look at the triple Q. I believe I then have some. Why would I wouldn't invest into a stock unless I feel it's going to beat a given benchmark. And broadly, if I'm active in AI and tech, the triple Q is pretty hard to beat. But I do think there will be multiple stocks that will exceed it. So I also go back and look at Harvard last year did about 9.3% return. The S&P did 23%, the triple Q probably 30%. Oh, but diversity, it dampens volatility, which is true. But I don't care as much about that. I have some money in cash. I have certain liquidity. I care about my net returns longer term. And if I have to deal with short-term volatility, I'm okay with that. I think the endowment industry, the institutional investor, I think many of them are beta huggers. I don't think they're alpha seekers. I think they diversify too much. And it's not something, now, given I'm a small single family office and active allocator, I'm going to skew a little bit to eating my own cooking, but I do believe in being more concentrated.
Well, when we see a lot of active managers come through here, and the only ones that we really entertain are those who are highly concentrated. Many of them hold 20 positions or fewer. And I think that in today's world, that's really the only way to beat the benchmarks. The benchmarks, whether it's the NASDAQ 100 triple Qs, which has been very, very difficult to beat over the last 5 years, or the S&P 500, which, as you mentioned, most hedge funds over time fail to beat this, especially after taxes and after fees. So we know that. We agree with that. And if we're going to invest in active managers, we want them to be highly concentrated, really have very deep bottoms up research driven process that can allow them potentially to pick the winners. Now, these kinds of managers also tend to run much greater volatility than the index. So they should be beating the index because you are taking more risk than you are with the index. So by definition, they better be beating it, or you're just taking more risk and having the same or even worse return. But Buffett did teach us, as you said, not to worry about short-term volatility. In fact, he doesn't even think of risk in volatility terms at all. And I think he's probably right about that. It's convenient and easy for Wall Street people to define volatility as the amount of standard deviation an individual security may have over time. But for a longer term holder, it's largely irrelevant. So it depends, Angelo, on the risk profile. And our families have very different risk profiles. They're all different. They have different reasons for wanting to grow their wealth. It might be philanthropy. It might be a special cause that they have that they want to fund. It might be the need to take care of the next generation that isn't as capable as they are, or there can be health issues. There's so many different permutations of why a family might want to grow its wealth and how aggressively they want to grow it. And some people are just more risk averse. And I think those people should not have concentrated positions, but those that are risk loving should. And in some cases, we'll see families with extremely concentrated portfolios in just one or two securities. And that's how they made their wealth. I think making your wealth through concentration is a good way to do it. Preserving your wealth through concentration is a good way to fail. The stats of individual companies over long periods of time, there's a survivorship bias, and many great companies fall by the wayside over time. And so if you make your wealth in an individual company, maybe that you started or you were in on early and you worked there for 30 years, that got you there, but that's not necessarily the best way to keep you there, if you know what I'm saying.
And Scott, you worked for one of the true legends. I'm the founder and was a longtime CEO at Family Office Association, headquartered out of Greenwich. I had all the Greenwich Titans come through and speak. One of them, about 10 years ago, your former employer, Paul Tudor Jones. What investment lessons did you learn from the great Southern gentleman and great trader?
Well, I'm so glad you asked me this, Angelo. I was fortunate enough to live in Greenwich for 8 years, and I worked for the great Paul Tudor Jones. And I would say that as great a trader as Paul is, and he truly is great, and I got to be near him and watch him during the entirety of the global financial crisis. He's an even better person. He's a generous person. He's a person that is willing to teach those around him with his considerable market wisdom. And he was probably the toughest boss I ever had, but probably the best that I ever had. I probably learned more from him than anybody else.
Is there one lesson maybe on
Yes, for
mitigating
sure.
risk?
There is. If I were to take one lesson,
Yes.
it would be the importance of risk management. What has allowed Paul to be in the game since the 1970s, approaching 50 years. I think he started in 1975 in the cotton pits at the New York. I think we used to call it the knife or the New York Futures Exchange. Was great risk management, and he learned a lesson early in his career in those commodity markets that I think his line was risk not thy entire wad on one trade. And so he was very good at cutting his losers. He was also good at getting flat if he was losing money for a period of time. And in the financial crisis, he encouraged us to manage our risk very well. And he really taught us how to do that. And at the same time, what was amazing about him is he was a great risk seeker because he had such great timing ability and instinct, but he would not sit with losing positions. And I think that was probably the most important lesson I learned from him among many others, but also the ability to endure some pain in markets. If you're going to participate in markets, you will have to endure pain because we're not
That's for sure.
right. And that mental toughness and endurance was something that I saw in him every day. And in the GFC, the early days of the GFC, what I remember most is how aggressive he was on the short side in the equity market. And I had been raised in the late 80s and all through the 90s that the equity market went up and up and up, and every now and then it would correct and have a brief bear market, but it would go and make new highs. And he saw it differently and while many of us were trying to buy the decline in equities in 2008, he saw through that and was able to really go for the jugular and just add to his short positions on the way down and make a killing. And I think that was one of his greatest years, 2008, where he basically returned the fund that year. Almost everybody else lost money, and he made so much that we actually had an up year. So I learned a lot from him about generosity, longevity, risk management, the ability to be aggressive when you really see it clearly. And so those are some of the lessons I took away from Paul Tudor Jones.
That's fantastic. Before we get back to investing, primarily then focusing on AI and the infrastructure around that, including energy, healthcare, Bitcoin, and then kind of take it to the home stretch, there's a couple of geopolitical / US and China questions that I think I do have to ask. And of course, they're going to be impactful at the end of the day to portfolio construction. Okay, you're going to get a tough one now. Will China invade Taiwan before Trump's term is up?
I would say probably not. I don't think so. And the reason that I don't think so is right now, China has some of its own problems. Now, the global trade war has taken the spotlight off of China's struggling economy. They still have a real estate bust. I think it's probably past the worst, but it's still there. It's still an overhang and a damp squib on their economy. They are going to lose some export markets. They're going to sell less to the United States. They're probably going to sell less to the European Union. And the world has woken up to the fact that China is a very, very dominant manufacturer, like we probably haven't seen since the US in the late 1940s, early 50s. It truly is dominating. And for China to believe that it can grow its already enormous manufacturing market share, I think is unrealistic. I don't think they're going to face tariffs exclusively from the US. I think there will be pushback. When the US market shrinks, they will dump product and goods on other markets. There will be pushback from that. I don't think they're really in the position. They are in the position of being in a great position, I think, militarily, because they have this manufacturing base. And if you get in an extended conflict with China, you have to understand that they have a manufacturing advantage, whether it's mortars or bullets or missiles or whatever they need to build. They have the infrastructure to build it. The United States really doesn't now. We are way behind where they are. And they know this, and they know if they get into an extended conflict in the Asian theater with the United States and even with our allies, which to some extent we've alienated, and would probably be less willing to follow us into a battle with China, that they have a long-term advantage. And the authoritarian system is a long-term advantage in the sense that they don't need approval from the voters to continue to fight. They'll do what they're told because they know what the alternative is. In the West, voters get to ultimately approve whether you continue to fight or not. Vietnam is a great example of that.
And a lot of Americans in the West have lost their will. They're standing for something from a moral perspective. And the reality of war is if you don't really have to win to save your country, your inner being of who you are, that will to fight longer term goes down. The fact that we don't manufacture is gravely concerning. I completely agree. And yes, with the challenges that you mentioned with China as well. But to think that we could go there, given the fact that we're way behind on drones relative to them as well, and the fact that we're not producing naval ships or manufacturing, as you noted, they're miles and miles ahead on certain things that could be impactful.
We maintain a lead in certain things like nuclear submarines, which could make the straits very difficult for them to navigate. I think their strategy is going to be, Angelo, to slowly strangle Taiwan. Slowly over time, they will get the prize that they want, I believe. But I don't believe it's going to be in the next 3 years of the Trump administration. And I don't believe that because they are afraid of Donald Trump. I do not think they are afraid of Donald Trump. In fact, he has been very clear that he does not want to fight and that he probably or may not even support Taiwan if there was an action by a serious action to just go grab Taiwan by China. So I think they know this. In some sense, this is their best window to do it because we're not as well coordinated. You could argue that the Secretary of Defense is one of the weakest we've ever had and the least experienced. We're having trouble recruiting as well as we used to for the U.S. military. There are all kinds of reasons that you say that if this is your golden prize, you should take it now. But
I mean, sadly, of course, your commentary, I would agree, is correct. And again, going back to we don't manufacture, not that I want to get in war, for sure not, but there are some times, again, you need to stand up for what you believe in and what's going to be valuable to you long-term as a country. And if I could get into a whole bunch of things on a unifying morality and a belief, but I don't want to get too far off track, but I do want to stay a little bit more on that theme, which relates to rare earths. One, are rare earths really that rare? The answer is, for a lot of it, really not. But the processing of it, the U.S., because of all the issues with, again, climate change and what's good for the earth and clean, which again, I hear you and I have some empathy for that as well. But China doesn't have these constraints. They could build nuclear power plants. They're manufacturing. They're doing probably a lot of bad shit that we would never be able to get done here. And their ability to kind of control the processing of rare earths, going back to some military challenges that we have, to some perhaps AI infrastructure and energy, we are not really in good shape on a lot of those fronts at all right now. How is that going to be impactful to the U.S. and how could that impact investing, including in rare earths?
This is, gosh, it's just points to what an amazing time we're in. And rare earths have amazingly been leveraged by them, even in the last 72 hours in these negotiations, to basically get a deal with the United States using rare earths. Now, the history of this is fascinating. They knew that this was a trump card for them years ago. And it's not that the U.S., yes, mining in the U.S. is difficult. Processing in the U.S. is difficult, was difficult. I think it's going to get a lot easier for reasons that you just mentioned.
I hope so.
They depressed the price of these rare earths to such a degree that capitalist countries could not compete. Even Australia could hardly compete. Canada has more rare earths than China does. But it's the processing. I think the cure for high prices is high prices. And I know in commodity markets, because I've traded them and I've studied them and I've worked in them for a lot of my career, that we will begin to manufacture and process these metals, even if we have to do it at a loss. And of course, when we start to manufacture, and Canada does and Aussie does, they'll start to flood the market with their inventory. Brilliant. That will hurt us. Of course it will. But we have ways to hurt them. And I think it was a brilliant strategy. They control these markets for now. They will not control them longer term. This is a wake-up call. We all realize this. It's not just the United States that's dependent on China for rare earths. Basically, all other countries are, and that will not be a sustainable position for them longer term. In the short term, it's a great weapon for them. When you weaponize something like this, just like the OPEC countries did in the early 1970s, there will be drilling all over the earth, and the cartel will be broken eventually, or at least buffeted. And so that's going to happen in rare earths. It won't happen overnight, but I think it'll happen over the next 2, 3, 5 years. And then the markets will be flooded with these products. Everybody will be losing money, but now we know they're strategic. So we have to eat the cost, and we have to do it. They're absolutely essential to our electronics, to our weaponry, to our automotive industry. Who knew? Who even thought about this 5 years ago? But they were smart. They cornered the markets. They got us over a barrel. And so there it is, but it's not going to stay there.
And everyone, we're heading into about our last 25 minutes with Scott. We're going to be effectively 100% investment focused. Going to be a lot of fun, so I hope you enjoy it. I know we have a lot of new people listening in today, and would like to, I guess I'm my own advertiser today. So everyone, I'm Angelo Robles. I'm the founder of SFO Continuity. I've been in the single family office community as an entrepreneur, a wealth creator, and someone who's had my share of challenges as well for many decades. Go to angelorobles.com and have an opportunity, if you're a qualifying family or a family office, to be part of something special. Unique proprietary content, including deep conversations in geopolitics, macroeconomics, and investing. I am extremely active in the world of AI, not just investing, but really as a control layer for everything and the AI family office moving forward and living through it myself. Go to angelorobles.com and learn about membership. Build upwards towards 100 incredible families around the world, some of the most iconic families, some of the greatest investing families on earth, and be a part of something special. We do in-person programming around the world, mainly US, but we are global, some digital, and a lot of unique proprietary intimate gatherings, including masterclasses that are very intense deep dives. This is not vanilla. This is not boring. This is not down the middle. We have strong beliefs, and we're not afraid to opine on them, similar to some of my questions and opportunities with Scott today. So learn all about it. Go to angelorobles.com. Scott, I had a guest on a couple of weeks ago. Maybe I was trying to be a little bit combative, if that's the right word, because I want to spark a discussion. And this will relate a little bit maybe to your endowment days, but even now, from my perspective, and you could probably tell I'm a little different, I think most investment committees underperform. I'm not so sure that Buffett wasn't right. I believe an investment committee that's an odd number and it's less than 3. Now, that may not be the greatest governance long term, but if you're successful like Buffett, it might be a good idea. I broadly believe probably in the number of 3. So I guess I'll disagree with Buffett a little bit. And where I'm going to throw the monkey wrench into things is if everyone has a similar educational background, cultural background, is about the same age, I think I'm getting a lot of anchoring. I'm getting a lot of groupthink. I'm not getting creative thinkers. What we learned in college 30, 40, 50 years ago, yeah, parts of it may be evergreen, but if you haven't adapted your thinking, then I don't think in today's world of AI, of crypto, of Bitcoin, of companies like Circle and stablecoins, old guard thinking is not going to get it done moving forward. Now, my biting comment was I absolutely believe, and I know I'm using it right now, AI will never be worse than it is today. And yes, you could have AI and AI agents effectively debate ideas. And I'm not so sure, unless you're telling me that Stan Druckenmiller is a part of your investment committee, that I'm not getting better ideas from that than what most investment committees are outputting.
All right, Angelo, a little bit on my experience with investment committees. I was very blessed to be part of that investment committee at UTIMCO, full of excellent professionals.
You're going to scold me, I know.
I think they did a great job, and that was a fine committee. But I agree with Buffett that it is difficult to get excellence out of committee rule, just by definition. When you're on a committee, there's emotion involved, there's personality involved, there are alpha males, there are beta males, there are, hopefully there are some women on the committee I think you get better results when you have diversity of background and diversity of opinion. And that's not just ESG. I literally think you get better results from having many different kinds of people on a committee. But committees tend to, and the people on them tend to go along to get along. That's an old Lyndon Johnson quote from the 1950s and 60s. That if you're a politician in Washington, you want to be successful, go along and get along. And largely on a big investment committee, you need to be polite. You need to respect other people's views. Everybody's got a
man. I'm really in trouble if that's the case.
And look, I've felt some frustration on investment committees. The one thing that I think is important about them is if you have an enlightened person and a great investor, and you use Stan Druckenmiller as an example, that's one thing. But if you have the wrong person in that position, it can be disastrous if they have too much unilateral authority. And that's why I agree with you that 3 is better than 1. 3 to me is about an optimal investment committee, as long as those 3 people know and respect each other and have the background to really be able to do it effectively. I think when you get committees of over 5, 7, I've been on committees with double-digit participants, and it's too much. It becomes politicized. It becomes about who's got the loudest voice and the biggest personality. Sometimes, not always, and I don't mean to intimate that about UTIMCO or other committees I've served on, but the flaws of investment committees are legendary. And you tend to get mediocre results, I think, from large investment committees, even if they're stacked with fantastic, well-educated and good investors. It's groupthink. We know groupthink is mediocre.
And again, kind of taking it a little bit to the home stretch and wanting to give people some real also kind of walkaways as allocators and investors. From my perspective, AI and crypto, mainly really the Rails blockchain and Bitcoin a little more specifically. But I think everything, just look at future forward. Really, if I focus in on that, and I know you're going to have more of a diverse opinion, I think I'm going to absolutely do bang up and do incredible. AI is going to be the control layer for everything. I agree with Eric Schmidt. It is wickedly underhyped. It's going to be coming at you faster than you think. Now, we don't have the time today, Scott. This would relate to a deeper discussion about the U.S., what's going to happen with job displacement, how is that going to affect politics, what happens if Taiwan gets invaded, although we touched upon that, ignoring some of those very important, maybe non-investment points. How do you look at allocating? Just look at the Mag 7. Just look at what all the incubators are funding. If you don't have AI or AI agents in your name, you're not even going to get looked at anymore. So how do you as an allocator balance hype with reality? Now, yes, everyone knows, because I'm more concentrated and I'm very AI focused, I am going to be definitely more all in on AI. You're probably going to have a more muted approach, but I would love to hear your perspective as an allocator.
First of all, on AI, I will admit to not being an expert, but I'm trying to become an expert user. And as a strategist, I've noticed that even over the last couple of months, that the ability, now I focus on, I use ChatGPT almost exclusively because I pay for it. That's what I learned on. That's what I first started to use. I know how to use it. I'm not familiar with Grok. I'm not familiar with Meta's version and all these others. I've concentrated on ChatGPT, which for me is just fine and getting better. As you said, it's the worst it'll ever be yesterday. And we can hardly fathom how good it will be in probably 2 years. But I'm using it as probably my most effective assistant right now. I use it as and that's no shot at the other people I work with. AI is the collective knowledge of all humans, really. In some cases, we might say all humans that have ever lived. So it's not fair to compare that to an individual human being. I use it to strategize. I use it for creativity. I use it to refine thought. I use it in my daily life. Heck, the other day I used it to find out how long I need to cook a sausage and what temperature the sausage is actually cooked to perfection.
Yeah, I don't want you to get sick, Paul, and don't have worms. So cook that pork very well.
So it's we can use it for darn near everything. I've used it for golf. It's changing my life, and it's going to change all of our lives. And I believe that we're vastly underestimating, just like we did with the internet.
Trust me, we are.
With the internet, we underestimated it. In the short term, maybe 1998, 99, we overestimated the internet. But over the long term, we vastly underestimated the internet. And I think with respect to AI, we're underestimating the short-term impact of AI. I don't see anywhere near the hype that I remember back in the late 90s surrounding the internet. Maybe we learned that lesson too well. And over the long term, I think we don't really have the imagination to understand how big this is. From a military standpoint, one of the things that I'm learning about and that is most concerning me is this merging of robotics and AI. And I think that China, for example, will probably end up, we know that their demographics are poor, that they have a rapidly aging society. Well, I'm not comforted by that, because I think what they're going to do is create millions of robots that are incredibly smart.
You're 100% correct.
And willing to fight, and they may be autonomous. And who knows, if they unleash these kinds of drones and robots on the world, what kind of damage could be done militarily? Will we have the manufacturing base to produce these in the quantities needed to?
At the moment, no.
Yeah, to be a deterrent to them. So I think about it, of course, in military and balance of power terms a lot. I'm concerned about that. I do think they have an edge on us in that. And in terms of AI and getting exposure to it, I wrote a report back in May of 2023. And at that time, a strategy report, you can find this at capitalcreek.com under market insights. all of my written work for the last 3 years is there. But I recommended very simply just own the NASDAQ 100, the triple Qs, because when you looked at the market capitalization, they all had exposure to the early stages of AI. I think as where we are today, you need to expand outside of that. Owning NVIDIA and Microsoft and Google and Meta and Amazon are not enough. We are pursuing investments carefully related to AI in venture capital. That's one way that we're getting exposure to it. I mentioned that I believe there's a longer-term convergence between digital assets and tokens like Bitcoin and artificial intelligence. So I think you can indirectly invest in it through digital assets. And I think you can still have some exposure to the so-called Mag 7. I think that's appropriate.
Of course.
And, I think there was obviously now in retrospect an incredible buying opportunity when they were down 35% back in the middle of April. Hats off to those who took advantage of that. And so that's how I'm investing, how we are investing in it. But I think most importantly, we need to invest as individuals in our education about how to use this valuable tool. Because if we don't learn how to use it, we're going to fall by the wayside as workers in the knowledge-based economy.
Scott, I don't know what to say other than, boy, are you 100% correct. In some ways, the edge now for people in the world of finance and the world of family offices, which again is going to be my bailiwick, which is why I created the AI Family Office. Going to my website, I am among the family office folk, the thought leader on implementing this at the most complex and highest level, which is why I admit I charge a premium for an immersive in-person masterclass. A little advice maybe to the audience. I also love OpenAI's ChatGPT. I think it's very good, the 4.1 model. But you all have to know more than just that from my perspective, Scott. One, you have to know how to toggle to the deep reasoning mode when applicable and what that means. Also, Anthropic is really, really, really good, and Perplexity. Now, I could also do hyper deep dives into Gemini, into DeepSeek, open source, non-open source, what is better at finance, at legal. By the way, one little tip, in the world of finance, Perplexity, specifically toggle to me either the GPT model, and I know I'm getting a little techie now, or the Anthropic model is incredible in the world of finance, and it will never be weaker than it is today. So those are all very important things that you mentioned. I don't know if you want to get into individual names besides some you mentioned, but there is one company that has skyrocketed into now a top 30 company. That would be Palantir. You look at their capability also from a military quote unquote perspective, and you just look at what's behind it, tailwinds, a variety of other factors. I know traditionalists or value investors will scoff, but to me, it's something over the coming years. I don't know if I want to quite say a no-brainer, but it is one that will probably have outsized returns relative to some of the individual Mag 7. I don't know if you have a specific opinion about that.
Yeah, I like taking things like that. You mentioned Palantir, you mentioned Circle. You mentioned,
yes, I did.
You mentioned other individual companies, and I like putting them together in a portfolio because I don't know which one's going to be the ultimate winner, but not too big of a portfolio. I think having somewhere between 5 and 10 of these in an AI basket makes a lot of sense to me. And then having maybe a basket of digital assets is another approach. And looking for taking intelligent, well-researched risk in venture capital. Remember, Circle and Palantir came out of venture capital. There will be enormous winners that we can't see today, but some of the great managers out there in venture capital, and fortunately we have access to some of them, will find these winners. And even living here in Austin is really neat, because Austin is a baby Silicon Valley, and we've got so many entrepreneurs here operating at the edge of defense and robotics and artificial intelligence and software, and the digital asset ecosystem. So Austin is a fantastic place for me to be later in my career, when I can meet these people and learn from them and start to understand better how this is all evolving. My approach would be to take a shotgun approach to a diversified portfolio, a concentrated diversified portfolio of public equities that have already come out and proven themselves, along with a barbell in venture capital into emerging companies that most people have never heard of, that could be, 1,000 baggers, like Palantir is proving to be. So, but having, once again, like I said, with Bitcoin and digital assets, zero is the wrong allocation. If you have zero, I would be very worried.
Well, I mean, anyone who's exposed to the public markets and any VC is not going to have zero to AI, but it's going to be indirect. Maybe it still is single digits. I just don't understand that. I look at the return profile expectations of real estate and some others that you mentioned, private credit. And again, maybe it's not my strength, but I do agree those are interesting for a part of the portfolio, depending on liquidity, goals, risk tolerance. But to me, if you don't have 30% plus in AI and at least some single digits in Bitcoin and crypto, like, I just don't see how you're seeing the world. And it's so different than how at least I think it's going to play out. Now, my numbers are greater than that, but that's just me for the work that I put in. I wish we had a little, we got a couple of more questions left, Scott, but I wish we had a little more time around the periphery of AI. That could include robotics, that could include quantum, and even energy and infrastructure. So there's so much to discuss. And I may give you a minute to go a little bit into the infrastructure part of it, but I will have a comment that you could comment on and then weave into infrastructure. I do believe that humanoid robotics broadly in general, will be the largest industry ever. It will create companies that will be top 10 companies. Maybe Tesla is going to be one of them with their Optimus, but there's so many other companies, many of them private now. We are heading into, again, assuming, I hope, no nuclear war and a lot of things that could go wrong and might go wrong. I just don't know. We're heading into very, very interesting times. When I hear someone state that in 20 years, we could go to bed and wake up 8 hours later, and there'll be 1,000 years of technological progress while we're sleeping. One, I don't know how that makes me feel. Probably not so good. I could go many negative directions on that, but I'll try to be an optimist. But broadly around the periphery of AI, energy and infrastructure, what would be your brief thesis of opportunities around that?
I don't know that I have any deep thoughts about that. I worry a little bit about the capital spending in data centers and things of this nature, because I don't know how to depreciate those assets. I don't know how long their useful lives will be. As you say, things are changing so rapidly. DeepSeek shocked everyone because it made us stop and wonder, do we really need all this power? Perhaps we can do this with chips that are not quite as advanced and without as much energy. And I think the efficiencies are just, AI itself is probably going to figure out how to do AI with less energy consumption. So it seems like we need these things today. Will we need them in 5 years at the rapid rate of change and innovation, and probably the lowering of costs? In my entire career, everything that's ever been created in technology just about costs less and less and less over time. And so I wonder about that, but I really probably shouldn't opine any more than that.
And maybe the final question or two, and we promised we would come back to it. We hinted at it, and that would broadly be digital assets, crypto. For me, it's mainly concentrated in Bitcoin, proof of work, but there's a whole variety of reasons as to why. I have a little bit in some others. I also believe in the rails to the system. Think of XRP, but what's behind them? Think of Ripple Labs. Think of the closeness relatively with the Trump government and how that's going to be the rails that banks are going to use moving forward. Circle, I think, is an incredible play. Definitely a fan of that. So again, I look at stable coins. How do you look at digital assets and how do you help to have maybe more conservative families, which will basically be every family relative to crypto that has wealth that probably is over age 40, understand that zero is probably not the best percentage to have?
Well, Angelo, it's difficult, I think. Digital assets are one of the most polarizing investment topics I've ever seen. And it seems to be generational in nature.
Yes.
We have quite a few young people that work at Capitol Creek. And I once asked for a show of hands, who owns digital assets, whether it's Bitcoin or Ethereum or Solana or RXP, we could name many of them. And practically every hand went up. And I know the people over a certain age here may own very little, and our clients probably don't own enough. But it's difficult because it takes some education to understand why you would need it. It takes some education to understand why you can add 1, 2, 3, 5% to a Bitcoin, and you can increase your potential returns quite dramatically, at least based on history, without increasing your risk very much at all. And many of us have portfolios that swing 100 basis points in a day. That's not such a big move for a portfolio in today's world. And if you lose 1%, you're just not even going to feel it. But if that 1% turns into 10%, you're really going to feel it in a good way. So I think there are asymmetrical returns available here still. And one of the things last week, when I saw that move in the non-gold precious metals, it made me think of something. So just like gold, Bitcoin has been absolutely dominant in this latest bull market for digital assets. Ethereum and many of the other alternative coins have kind of been sideways, some of them even down. And I think we could be approaching a place where the alternative currencies play some catch up to Bitcoin, just like silver and platinum are starting to do relative to gold. So that's something I'm thinking about. It may be a little more of a trading mentality there, but I think that most portfolios need a non-zero position in Bitcoin at least, and those who are willing to take maybe a little bit more risk. But I actually would see a portfolio of 3 to 5 of these as maybe even less risky, because Bitcoin dominance is not guaranteed. And I think it's relatively easy to understand the store of value concept with Bitcoin, that there are a limited number of these coins. Unless something happens to the software, it will remain that way. There are some concerns about quantum computing, and would that be able to disrupt some of these tokens? My cursory research into this is, if it happens ever, it's quite a few years away from happening. So I don't think that's something to worry about in the near and maybe even intermediate term. But I think having a portfolio of these, or even just a single position in Bitcoin, adds to your potential returns and doesn't add much to risk. And what I really like seeing recently is it seems like the correlation with risk assets is really breaking down. We know that back in 2022, the correlation between Bitcoin and the QQQs was very tight. That it felt like Bitcoin was triple Q on leverage. I don't think that's the case anymore. I think Bitcoin has broken away from that. that is becoming more and more uncorrelated, which I think is fantastic. Then you're adding an asset to a portfolio and you're actually reducing your correlation and increasing your potential return, which is super exciting. And if you size it right, that's a nirvana. I mean, you got to have that, right? And I think that's part of the bull market that's going on right now.
Of course. I mean, there's one of the things I've learned. Most people would rather be right than make money.
Oh, for sure.
There's no question. Probably that's a lesson from Tudor as well. They let ego and ignorance, the lack of putting in the work, which is why, although I started investing well over 10 years ago and started to speak about it, it was during COVID that Tudor Jones came out with a relatively small 5-page white paper that really got me even reinvigorated. And I accepted the volatility. 2022 was terrible, including for really everything or practically everything. And I stayed with it. So you bring up the age issue. I completely agree. And the world is changing. To not accept the realities of AI and broadly crypto, and to me, a little bit more centered on Bitcoin, but also the rails around it and stable coins and things like Circle, like you are missing out on really where the returns from my perspective are going to be. And I'm not afraid to make those comments.
Angelo, you're missing opportunity. And another thing I learned from Paul is don't be dogmatic. Just because it wasn't invented when you were 28 years old doesn't mean it's not going to work. We got to be open-minded, and it requires some study on our part to stay current with what's going on. Being open-minded in investing is one of the most important things I could relay to this audience. Being dogmatic is a real hindrance to producing good returns. There was a great technology analyst when I started on Wall Street. I started on Wall Street in 1989 at a great firm called Kidder Peabody. And we had an excellent technology analyst named David Corus. And if David ever sees this, he'll laugh at this. But he said to our analyst team, do you want to be right or do you want to be rich?
Exactly.
And I didn't understand that. I want to be both. And but it's really much more important to be rich than to be right. And so you can't be dogmatic. If you're wrong, cut your losses, move on, and go to the next hole. But if you're not open-minded, you won't be right and you won't be rich. You'll miss on both counts.
Well, Scott, you've been very generous with your time. I know it's very rare that you do longer form interviews. Everyone, we are very fortunate to have Scott Slayton, CFA partner and chief strategist at Capitol Creek Partners. Scott, for those that would like to learn more about you and about the firm, how could they do so?
Yes, we have an excellent website, capitalcreekpartners.com. Under the tab at the upper right that says Market Insights, you can find all of my written research, interviews like this one that I did today with Angelo. And I've also conducted interviews of other Wall Street Titans myself, which I've called them webinars. Those are up there. And I've recently started a podcast called the 3 in 10 podcast, where I take 3 discrete topics that I think investors need to know about and understand over the course of the last week. And I delve into those, and I do it very economically in 10 minutes. So 3 things in 10 minutes, mostly focused on the intersection of economics, geopolitics, and financial markets. You know, it might be a piece of data that came out during the week that I thought was really interesting. It might be an earnings report that I delved into and discovered something interesting. It might be a market like silver last week that broke out to 5-year highs. So we get into a lot of interesting things very quickly, and that comes out every Friday. And of course, I write these long strategic pieces like I did on the dollar back in March. I'm writing one on the potential for a fiscal crisis now, which will come out in a week or so. I wrote one on inflation back in 2022 and AI in May of 23. So there's a whole repository there. Capitol Creek is a multifamily office in Austin, Texas, focused on ultra high net worth families. We have 23 families, and we provide their asset allocation, reporting, organization, access to alternative investments in things like private equity, private credit, venture, energy, real estate, all of those things. It's one of our core beliefs is that public markets will continue to generate decent returns, but over the next 5-10 years, with equities valued where they are today, fixed income being largely a coupon clipping market, you're going to need to do some things outside of that, as Angelo has also endorsed, to generate returns like we've been able to generate pretty easily over the last 15 years. We're going to have to do other things to do that in the next 5-10 years.
And from the website, Scott, could people reach out? Is there IR? Is there an email, or you want to redo again the URL? And if you have a LinkedIn, people could follow you there as well.
Yes, of course. You can reach me on LinkedIn for sure.
Great. And again, the URL, is it the company name, Capital Creek Partners?
Yes, capitalcreekpartners.com.
Okay, that is simple and straightforward. Scott, it's been great to have you on. You've been a good sport dealing with some of my crazy questions. I greatly appreciate it. And so much that I learned from listening to you. Everyone, I'm Angelo Robles, been in the family office community a long, long time. But like Scott said, hopefully I'm not dogmatic. But those of you that know me know that I definitely would rather be rich than be right. And yes, I do have strong opinions, and I am a little different than what many of you may be used to in the family office world, even though I am a bit of an old timer for decades within the industry. Go to angelorobles.com and learn more, become a member, immerse yourself, have direct introductions to people like Scott, to meet your peers around the world, to get my proprietary content that I don't share, and all the work, and it's a lot, that I'm doing around the world of geopolitics, macroeconomics, and investing, and mainly, of course, around AI and the AI family office, where I am all in. I'm doing it myself, the infrastructure, the architecture of it, including AI agents, and I am shocked. And the percentage of family offices that have really gotten on board, it is under 1%, and it is so good now. You have a chance to gain a massive advantage. Go to angelorobles.com, look into membership, and look into my AI Family Office Masterclass this summer in New York. I may do a truncated version in Aspen later this summer. And definitely, it's really an anchor and a foundation to many of the things that we're doing. Again, thank you all so much. And Scott, thank you again for being a great guest. Look forward to seeing you soon. Thank you.
You're very welcome. It was a pleasure to be with you, Angelo.
My pleasure, Scott. We are off.